Everyone, welcome. This is Michael Jacobzak with USFastTrack.ca. Just doing our presentation regarding U.S. tax introduction, which we had our meetup group on Sunday discuss. For all those who came out, we appreciate the support. We had a good, almost 30 people that showed up, so it was definitely a good turnout. A lot more new faces, which we like to see. So we're going to replay this presentation. I'll be discussing all the slides. USFastTrack.ca is my company that we, a little background about myself. I've been buying in the US for the last 2 years, mainly in Atlanta, Georgia. And so this is my background in a sense regarding US real estate. This presentation is on U.S. tax. It's an introduction kind of course. Just to get started here, what we're going to be talking about is basically the introduction, general tax information. We will touch base on a few entity structures and questions, which obviously we won't take no questions for this presentation since nobody is here. So moving forward, warning, here's my little disclaimer. This is not tax advice. Like I said, I'm not a cross-border specialist, accountant, or even a lawyer. This information regarding taxes for educational purposes only and should not be considered any legal tax advice. Please consult a cross-border accountant/lawyer when setting up your entities or buying real estate in the United States. What I'm trying to accomplish with this presentation is basically just to get you some understanding of the U.S. tax system and how it affects Canadians. Like I said, it's not advice. The reason I kind of want to have this, we wanted to have this discussion, is basically so when you do sit down with your cross-border specialist, that you can at least keep up with the conversation of what's going on. I remember when I first started, I'd go to sit down with accountants and, I'd kind of be lost just from the get-go of what the heck they're talking about. So I'm hoping by this presentation it gives you a little knowledge so that you can at least keep up with the conversation. At some point, some of these accountants, they charge per hour, so you don't want to be learning the basics going into it. So moving forward, here's the introduction. I have a quote here from an accountant and partner of KPMG, which is a big, worldwide firm that does accounting stuff. Residents of Canada have to pay tax on worldwide income to Canada no matter where they earn it. So if you're a Canadian, you're making money, for instance, in the U.S., you have to claim it on both sides. So on definitely the U.S. side and on the Canadian side. So that's from a good reliable source. Just to start off, I got my little diagram here. It says U.S. income. You got to file both taxes. Now, one of the biggest questions that come up with taxes is double taxation, because if you're paying taxes in the U.S. and you're paying in Canada, it sounds like you're getting double taxed. So we have a definition of double taxation. Taxation principle referring to income taxes that are paid twice on the same source of earned income. Now, if you pay tax on the same income but don't get credit for it, you're paying a double tax. But if you set it up right in the U.S., when you buy real estate or earn income, they will give you credit for whatever you pay on the U.S. side when you pay your Canadian. Sounds complicated, but for instance, we'll just say your taxes are owed 10% in the U.S. side. And Canada's typically going to have higher taxes because we have free healthcare and all that. So just say you're paying 15% on the Canadian side. Now, if you set it up properly, you will get credit for that 10% that you already paid on the U.S. side. So therefore, you're only paying the max, which would be 15%. That's why it's very crucial to sit down with a specialist, because depending how you're going to be holding property, it will reflect your taxes. This is very important. We'll get into kind of entity structures near the end. We don't go into a lot of detail on a lot of these issues in this presentation, because people get paid a lot of money just to go to school for many years to learn about each individual aspect of this presentation. So we'd be here all day. So tax credits, we just touched base on it. Basically, you can claim a federal foreign tax credit, which is exactly what I was explaining. If you paid U.S. tax on U.S. income that you are reporting on your Canadian return, you may be able to claim a federal foreign tax credit to reduce your Canadian federal tax payable. So that's exactly what I just explained in the last slide there. As you see in this presentation, I'm going to have all the information sources where all this information is actually from Revenue Canada. So it's from a reliable source, and I have all the information on here. I also posted the pamphlet on our group's page if you want to actually grab the full pamphlet, because this is the full pamphlet's very long, and I kind of condensed it by pulling certain information. But all this stuff, you should at some point go through it. You don't need to memorize it, but just have a good understanding. So tax credits, very important when it comes down to buying in the U.S., especially if you're renting it. So our next slide here is non-resident versus resident alien. Not aliens from outer space. As a foreigner, we are aliens to the U.S. As a Canadian resident who spends part of the year in the U.S., you are considered either a resident alien or a non-resident alien of the U.S. for U.S. tax purposes. Generally, resident aliens are taxed in the U.S. on income from all sources inside and outside, versus the non-resident aliens are taxed in the U.S. only on income from U.S. sources. So that's the big difference. If you're a resident alien, you're taxed on income from all sources inside and outside. So that's very important to understand which one, especially when you're filing your taxes, of what's going to happen there. Therefore, it's important for you to determine if you're a resident alien or non-resident alien. So the next question is going to be, how do you consider which is which? So to determine if you are a resident alien or non-resident alien of the U.S. for tax purposes, you first need to know if you meet the presence test. So the test, so there's a formula of basically how to calculate your how many days you're in the U.S. and if you go past the certain amount of days. We're going to go through the formula just to touch base on it, but to kind of dumb it down, because I know we're going to go through this formula and you're going to be like, wow, why is this so complex? And why can't it be a certain amount of days and just that's it? But basically the rule of thumb, if you're under 120 days per year, you don't need to calculate all this. Because some people are going to say, oh, I don't know how many days, and I think I was down there and I forgot, because it goes back, this formula goes back 3 years. So it's obviously the year we're in is not really an issue. You can kind of ballpark what you did, but this is more for people that are going down there for a long period of time, in a sense like 6 months. So a lot of snowbirds. Definitely keep track of how many days you're going down there. So basically this test uses the number of days you were in the U.S. during a 3-year period, the current and the 2 previous years, to determine if you're a resident alien or non-resident alien. To meet this test for 2011 tax year, you must be physically present in the U.S. for more than 30 days during 2011 and 182 days during the 3-year period based on the following calculation. So this is where it gets kind of crazy. Count each day in 2011 as 1 full day. Not a problem. Count each day in 2010 as 1/3 of a day. And count each day in 2009 as 1/6 of a day. So that's when it gets kind of like, holy, I gotta do math. So here's the example. And I'm not going to go through the actual example. We're just going to go through the number of days because it's kind of irrelevant. But basically, it's about a couple. They have a trailer in Florida. Yada, yada, they go down there. And during 2011, they were in the U.S. from January 1st to April 11th. So basically 150 days. During 2010, they were in there for 138 days. And during 2009, they were down there for 156 days. So each day in the U.S. during 2011 counts as a full day, so 150 days. Each day in the U.S. during 2010 counts as 1/3, which comes out to 46 days. And each day in 2009 counts as 1/6, which comes out to 26. So you add all those together, comes out to 222. Since the total is more than 182 days, they are considered resident aliens for 2011. So obviously, if you're under that, before moving forward, you're okay. In a sense, you're non-resident. Like I said, the shortcut is, if you're under 120 days per year, you don't need to do the formula. But if you're going over, like I said, you're going down there for a bunch of months at a time, especially when you start to retire more, you'll be down in Florida or Arizona more often. Just somewhat keep track. I usually get the question, how is the U.S. keeping track of people? You do have a passport. At some point, I don't know their system, if they're marking down. I tell everyone, at the end of the day, it's the U.S. government. If they want to find out stuff, they have systems to do all that. So I wouldn't test their ability to do that. Okay, so our next slide is, do you have to file a U.S. tax return, which is the form called 1040. If people know tax forms, they're all based on numbers. They can get there's all kinds of forms out there. A 1040 is the U.S. tax return form. So if you're a non-resident alien, your income that is subject to U.S. income tax is divided into two categories. So this is for non-resident aliens. Income that is effectively connected with a trade or business in the U.S., including income from the sale or exchange of U.S. property. So that's if you sell your property. It's effectively connected. The second is income that is not effectively connected with a trade or business in the U.S., but is from the U.S. sources, including interest, dividends, rents, and annuities. Effectively connected income, after allowable deductions, is taxed at the same rates that apply to U.S. citizens and residents. Income that is not effectively connected is taxed at 30% or a lower tax treaty rate. So that is very important to know, because, like I said, if it's not effectively connected, it's going to be taxed at 30%, which is very high. Now, all of the stuff that we're covering there's a bunch of different exemptions and all that. Like, everything has exemptions. That's why you're going to have a specialist that knows all this stuff, that, if you want to call them loopholes or tax breaks, there's certain things that these cross-border specialists will know that you will not know. That's why it's very important to know these people. And like I said, this is just a general understanding of all this stuff. So continuing forward, if you own U.S. real estate or real property, such as a condominium or house, you should be aware of the tax consequences of renting it out or selling U.S. real estate. So this is going to come to in factor for a lot of Canadians that are buying U.S. Real estate and renting it out. If you receive rental income from this property, as a non-resident alien, you are subject to U.S. income tax on rental income you receive from the U.S. real property. You are considered to receive the income from a U.S. source even if it was paid to you while you were in Canada. Rental income is not effectively connected with the conduct of U.S. trade or business, and as such is subject to 30% tax on the gross income, with no expense or deductions allowed. So right there, everyone goes, wow, you're going to get, 30% of the gross. You may not be, that might be all your cash flow. So the next point is very important here. However, under the Internal Revenue Code, you can elect to treat rental income as income that is effectively connected with the conduct of U.S. trade or business. So that brings rental into effectively connected, which, if you remember the slide before, we can deduct all our expenses on there, which will not be, chances are 30% gross is your profit margin in the rental. So for more information on rental income or expenses, get the IRS publication. Like I said, there's a bunch of pamphlets for each stuff we're talking about. So this one's including rental and vacation homes. All this stuff, at some point, print it out, keep it on your nightstand, read it once in a while just to be familiar, especially when it comes to tax season. Just so that when you sit down with your accountant and he asks you, you know, they should make the judgment call what makes sense for you, but at some point you can ask about it and they'll give you the reason why they're doing things or recommending certain things. If you can keep up with that conversation, you're ahead of the curve compared to some people that, you know, are buying and not realizing what they're kind of doing on the tax side. So if you have not made an election to treat your U.S. rental property income effectively connected with U.S. trade or business, then tenants or management agents, brackets withholding agents, have to withhold a 30% non-resident tax from the gross rent and send it to the IRS form 1042, which is an annual withholding tax return for the U.S. Now, I usually get the question, like, you know, why are they holding back 30%? And the main reason is, as a foreigner, the government or the IRS needs to know, like, if they pay you all your money and you don't file your taxes, it's a hard time for them to come chase you for the money. So all they do is they say, hey, pay us 30%. When it comes down to taxes, we'll have your money at 30%, and chances are your income's going to be under that they're going to tax, and they'll release the money that they owe you. So there's being the bigger brother saying, you know what, we'll hold on to the money, and then you'll get your money back. Now, if it's fourth quarter of the year, obviously them holding on to, if you sold your property or whatnot, it's not a big issue because you're going to get a refund or whatnot in the upcoming quarter or when taxes are filed. But just say you're, like you sold the property in first quarter, or, they're holding your gross rent from basically January all the way for the whole year. Obviously, that's a lot of money at some point, that, especially if you're not all cash flowing that much, it's coming out of your pocket for the year. You can actually file, and this is more on when you sell property, a withholding to get that money kind of credited back right away. So basically what you would do is you would fill out the proper form and send it in to the IRS, but then 90 days or so you should hear them back to say, yeah, don't give us this much, show us your net, and you would send whatever money in, or they would release some certain amount of money. So just to make note. So if you want to be exempt from the 30% non-resident withholding tax, you're making an election to treat the U.S. rental properties as effectively connected with U.S. trade or business. You have to give the tenant management agent of the Form W-8ECI, which is a certificate of foreign person's claim that income is effectively connected with the conduct of trade or business in the U.S. For more information regarding this, like I said, there's IRS publication 515, withholding of tax of non-resident aliens and foreign entities. So like I said, these are some stuff that you're going to want to go through, but this is just to give you a basic head start. So the next situation is, did you dispose of U.S. real estate? As a non-resident alien, gains or losses you have from disposing of U.S. real property interests are considered to be effectively connected with the U.S. trade or business. If you sell or otherwise dispose of the U.S. real estate, the purchaser or his agent is generally required to withhold 10% of the gross sale price. However, there are exceptions to this rule. For more information, see the section called U.S. Real Estate Property Interest. For instance, I can just tell you from my experience, the exemption is if one of the exemptions, if the property is valued under $300,000, they don't generally need to hold that. Also, I think if a homeowner is living in it and it's not selling to a foreigner, they don't need to hold it. So there's a bunch of restrictions. I'm not going to name them all because I don't even know them all off my heart. But like I said, that's something that, read that. They'll give you, most title companies will not know this, and they know the federal thing is just to hold it back. So sometimes you need to have your accountant, keep in touch with all these people so that they're on the same boat. Because like I said, at some point, if they whatever they keep aside, because gross sale is the gross sale, not your net profit. If you sold it at, you know, $500,000, they're keeping aside $50,000. So the number is not a small number, and especially if you didn't make $50,000, they're keeping more money than they obviously should, because that's not your net. Or just say you lost money, they're actually keeping, you know, they're holding more money than they're going to even get, in the sense they're not going to get anything. But you definitely want to keep, you know, definitely keep all your receipts and all that, everything you're spending when you're doing U.S. real estate. Keep a track record, because like I said, they're going to want to see all that stuff. So moving forward here, if you have to file the form 1040 NR, which is non-resident alien income tax return, and the required schedules report the gain or loss. If you own any real estate or real property with other persons, such as your spouse, each has to file a form 1040. So a lot of people, they're gonna, you know, if you have your wife or your husband on title, they have to file it as well. Also, if you have partners or interest in a partnership, you treat the same. It's treated as the same as real estate, especially if the corporation owns a certain amount of real estate. All partners have to file your own taxes. Like I said, there's more information on the bottom there. U.S. tax estate for non-resident aliens. So another big issue is estate taxes. Now, this refers to basically when you die and you own real estate, depending on how you're holding that property, it affects the whole aftermath of you dying. Obviously, you passing away, you don't have to worry about it, but anyone, your spouses and whoever's in charge of your estate, is going to either hopefully love you or hate you, in a sense. How, if it's set up properly, then, you know, everything, it'd be a lot easier for them. So basically, let's just read this. The U.S. imposes a state tax on the transfer of a deceased person's taxable estate. The taxable estate of a Canadian non-resident alien includes the following assets located in the U.S. real estate and tangible personal property, stock in U.S. corporation, debt issued by or enforceable against a U.S. entity, but most corporate debt instruments issued after 1984 are exempt from the U.S. estate tax. And interest in a partnership if the partnership's principal place of business is in the U.S. The U.S. estate tax is based on the fair market value of the asset on the date of the death. So there is no impact from a profit or loss because of deemed disposition of a date of death. Non-resident aliens cannot claim foreign tax credits on a U.S. estate tax return for deemed disposition of capital gains, including taxes paid to Canada. So just to touch base more on that estate tax, like entity structures, which were, like I said, I'll touch base on. Like, the reason why you have entity structure is for tax reasons and also liability. A lot of times, like, estate taxes, like, I've been to meetings that are about, you know, estate taxes, really, really boring stuff. And normally, it's a lot more older people in their 50s and 60s versus younger people, just because they have the higher risk of obviously passing away, since they're, you know, older people. Now, but that doesn't mean you gotta, you know, if you're a younger person, you definitely gotta keep that in mind, to have everything in order, because you never know, right, what's gonna happen down the road. But normally, a lot of people that are, if you're buying a house, you know, for vacation purposes, or you'll rent it out for the next couple of years, but, you know, you kind of want to transfer it to, or live in it after, or use it as your retirement home. They usually tend to set up trust entities that are, it's a trust. It kind of covers you for the estate tax side, and it's got perks on different levels. But like I said, that's we'll be talking entities in a bit. But a lot of trusts are set up for that reason. But moving forward, like I said, we'll talk about that in a bit. Individual taxpayer identification number, also known as an ITIN. So if you ever hear the people talking about ITINs, that's what they're talking about. It's basically an ID number. If you have to file your U.S. tax return, you must have a U.S. taxpayer identification number. Generally, this is like a social security number that's issued by the United States. If you don't have a U.S. social security number, you are ineligible to apply for one. You must use an IRS ITIN number, or taxpayer identification number, individual. So basically, yeah, if you're an American, you'll have a social security number. If you're dual citizen, if you have a social security number, that's what you're using. But for most of us, we don't have one, so you have to get an ITIN number. Now, you can't just go and apply for one. In a sense, they don't just hand them out to everyone. You need to have some reason to get one. So normally they ask me, do you have real estate, or what's the purpose? And you say you own real estate, and you put some addresses down on the form, and they kind of okay it because they're like, whatever. They do their checks. So some notes here. Do not use your Canadian social insurance number to file your U.S. tax return. If you send it in, chances are they'll just reject it. Hopefully they tell you why, but hopefully you're not even doing that. If you were issued a U.S. temporary identification number by the IRS for a tax year before 1996, you can no longer use that number and must apply for an ITIN. So this is anyone that's been buying or I guess investing before 96. You would have got that number. Definitely need to use an ITIN now. An ITIN is for tax purposes only. It is not confirmation that you can work or live in the U.S. So it's not a green card. And basically, to apply for an ITIN, you must complete an IRS W-7 form. So just in case that comes up with your accountant, that's what he's talking about. Also, what you need, you're going to be paying your federal taxes, but you also got to make sure some states have state and local taxes. This is required. Every state's different of what they're paying and how they operate. Here's a website on the bottom here, statelocalgov.net, and they'll show you, they'll have the list of requirements and all that. So that's another thing. If you're buying in multiple states, don't just treat each state like it's the same. They're not. Something to make note. So our last part here is entities. Basically, another question that gets come up a lot is people, they think they need to have some big entity structure to start buying in the U.S. I don't know. I guess it's from all the information out there, but at the end of the day, you can buy real estate in multiple ways. For instance, personal. You can put it in your name, buy it, put a contract in your name, close on a property with your name. It's not illegal. That's one way. The reason why at some point that may not be the best way is because liability. If I tell people at some point, if you were worth like $10 million, it's probably not a good idea, definitely not a good idea to keep something in your name, because in the U.S., 95% of the lawsuits in the world come from the U.S. So they grow up on suing people. So obviously, if it's in your name, they can come after you for a lot of your liability is crazy. So, but at some point, it's a lot of people that don't have a lot of net worth. They might just buy it in their name, and obviously, you're always going to have some insurance and protection on that. But that's with any type of structure, you're always going to have some insurance. The next entity, there's different types of partnerships. Like for myself, we use like limited liability partnerships. Is a great way to joint venture and partner with people to purchase real estate. There's a bunch of different partnerships. We're not going to go into all of them, but at the end of the day, important note: if you're partnerships need to consist of 2 or more people, or companies or entities. One's going to be a general partner, and one's normally going to be or the rest are going to be a limited partnership, or sorry, a limited partner. Limited partners, they have their liability is only for what they contribute to the partnership. So you can be a limited partner with your name, and people can't really come after you if they go after the partnership. Where the liability really lies is in the GP, which is the general partner. they have all the liabilities. So they're usually in charge of like day-to-day activities. So they're liable, and you definitely want to have some protection on that end, a little bit more than if you're just a limited partner. The next entity here is corporations. A lot of people talk about, if you do your research, LLCs, which are limited liability companies, come up a lot. And the main reason is because it's like one of the #1 entity structures for Americans. Now, we are not Americans, so I don't really, you shouldn't be buying an LLC, but it's very possible to do it. You just got to do it right. And I usually tell, it's kind of overkill when you start buying, like a lot of people come to me, and we did a video on kind of like tax stuff prior to this, and we were talking about LLCs because, I get people that come up to me and they have this big spider web of entity structures, and I laugh sometimes because I'm like, it's so overkill, especially, it's overdoing it. I usually tell people, like, at some point you could probably set up a structure from day one that's going to benefit you perfectly throughout your career in the U.S. on the real estate side. But some of these structures, like some of the structures I've seen, it's a $100,000 structure if I bring it to my accountant. And at some point they'll do the work, but it's they'll usually say it's kind of overkill for, you're just buying one property right now. Why are you going to spend $50,000 to set up all these and then the property's worth $50,000? Like, you have a better structure than your property. So sometimes I always say, start off with whatever entity or whatever way your accountant says to move forward. At some point, you're going to get to a level where it's like you need to restructure things because you're getting bigger and you're growing, which is great. So in the long run, yeah, you're going to overpay, for a few entities here and there, but realistically, are you going to be complaining when you have to pay an extra $5,000 here or there for a different entity structure or whatnot? No, because you're making money. So LLCs, don't fall into the hype of that. I've even had some Canadian people promoting that. I don't promote it. I don't recommend it, but like I'm not a tax advisor, so don't take my word for it. Just do your learn first and read as much as possible. So, and if it makes sense and your accountant says makes sense, obviously you're going to move forward. Trust, as we covered before, they're mainly for like I said, there's many perks and all that. The reason why a trust is not cheap to set up, so it's, and like I said, it's usually for, a lot of people use it for the estate reason, tax reason, but that's another way you can hold property. Also, you can hold property with a Canadian, U.S. company, or any offshore company. That's another way. So it could be a corporation or any kind of existing company that you own. At the end of the day, you got to remember, whatever entity is holding it, however their taxes, if it's corporate taxes and all that, that's how you're going to be taxed at. So if it's your personal name, it's going to be personal on your personal tax return. So you just got to make sure that whatever entity you're using, you understand the tax implications and also the liability. That if you're getting liability protection, if not, and vice versa. So then we had our question period. Obviously, this is a replay. We're not going to go over. I kind of touched base with some of the questions that came up and all that. Overall, the turnout, like I said, we had a good almost 30 people, a lot of new faces. We appreciate everyone coming out to support us. Like I said, please leave a review on Meetup. It allows us to grow as a group. Also, like us on Facebook. That's referring to my US Fast Track. If you look us up. Like I said, we deal with Atlanta, Georgia. If anyone's looking for that market, definitely give us a call. We have a pretty strong foot there in what we're doing, and we're expanding. We do turnkey stuff for Canadians. We also do different partnerships. But check us out on USFastTrack.ca. I appreciate everyone tuning in. Please comment and please share this with anyone else that you know that might see some benefit in it. And we look forward to seeing you at the next meetup. Thanks a lot, guys.